Today I'm going to go over a clean energy ETF called QCLN. QCLN holds a broad portfolio of US listed firms in the clean energy industry. Eligible companies must be manufacturers, developers, distributors, or installers of one of the following four subsectors: advanced materials that enable clean energy or reduce the need of petroleum products, energy intelligence, smart grid, energy storage and conversion, hybrid batteries, renewable electricity, solar, wind, and geothermal. Right now QCLN holds 61 stocks, and this is not a lot of stocks, so that means it is not a well diversified ETF when it comes to their holdings. But we'll take a look at some other ways that this ETF is more diversified. The thing about QCLN's top 10 holdings is that they make up 56% of the entire portfolio, which means that it is a bit of a riskier investment, combined with the fact that they only got 61 holdings. Tesla, NIO, they are both in the electric vehicle sector. Semiconductors here is also something that this ETF does quite a lot of in M-phase and plug power. Those are some of the most common names here. With this ETF, you will most likely see a bit of volatility, and you can see that in the stock price as well. If we go over here to like the 5-year chart, you can see we had this massive growth in 2020, and that has collapsed a bit here in 2021. And then for the most part of 2021, we've actually just been kind of trading sideways. We had this bump here with like 30% bump, and that has now declined again, and that was like the hype of electric vehicles. You saw Tesla going up massively and NIO going up massively, and M-phase going up, like hitting all-time highs every single day for like, yeah, it was crazy. And now that has kind of stilled down. Something that is very important when you're looking at an ETF is the industry exposure. And as you can see right here, we are in a lot of semiconductor equipment. We have 33% in just that. Next is automobiles, 22% is in that industry, and that is of course the heavyweight of Tesla and NIO. The third on the list is electric equipment, and that is 19.5%. Something that I definitely also want to look at is right here, what kind of company sizes are we looking at? So you can see here, mid caps is 51%. I really like that because the mid and the small caps are set up for much more growth, which I'll go over in a minute, than the large caps. So I really like that both the small and the mid caps are in a higher position than the large caps. Of course, the reason being for the high weight in mid and small caps is because a lot of these renewable energy, basically if you take Tesla out of the equation, you can see a lot of these top 10 holdings, they're not trillion-dollar companies, because we're in this sector, is an upcoming market, this whole renewable clean energy thing. So there will not be these huge developed companies. That is why. But the reason that I like these mid and small caps, if we take a look at this right here, which is some chart of the forward PE ratios for the S&P 500 index. And so this is basically an average of the PE ratio of the S&P index. Not the S&P 500, but just the S&P index. And you can see here the S&P 500 large caps, which is the index that a lot of people refers to as the American market. You can see, if we look at this graph over the forward PE, you can see that it is relatively high right now. It hasn't been this high since, what is that, like 2001 or 2. So it's a long time since these forward PEs have been so high that they are now. If we look at the S&P mid caps, you can see that already has been brought down a lot, and you can see that it's pretty much just an average of what we've seen for like the past 20 years. And if we take a look at the small caps, you can see that is pretty much, that is under the average. Draw a line here, you can see that is much under the average that we have seen for the past 20 years. So small and mid caps are much cheaper in the S&P 500, and the S&P 500 is of course a lot of different sectors, but it wouldn't surprise me if this also was the same thing with these clean energy stocks. Let's take a look at the top 10 countries that QCLN are in. So first of all, the United States, as they say in the description, they invest in US listed stocks. So only US listed stocks. And you can see we have 82.5% in the United States. So obviously, when they're US listed. They're not going to be much outside of the US, but we have China 8.8% and Canada. So very standard for these clean energy ETFs. They like to have in China and Canada and the United States. That's pretty much it. Obviously, they're not really diversified like geographically outside of the US that much, but the US is a huge economy, so that is why. So don't worry too much about that. If you're interested in like a more geographically diversified ETF, then go and check out a video. I'll link it right up here, where I take a look at icln, iShares Global Clean Energy by BlackRock. That is another ETF that is much more diversified in terms of geographics. The average 10-year return is 22.29%. And this is like data from like a month ago when I made another video. So yeah, 22% year over year the past 10 years average. That means that if you invested 10 grand 10 years ago, that money would now be worth $50,000. That is a 5x of your money in 10 years. That is great, much better than any S&P 500 like index that you can find. That is huge growth. So this ETF has seen a lot of growth, and in my opinion it will see much more to come. And a little dip like this for like half a year, where it's trading kind of sideways. When you're thinking about clean energy, you're thinking about the long term. You're thinking about the changes that we have to make, and that the administration, something that I just want to, when the Biden administration, like building up to the election, this ETF and most clean energy ETFs started pumping because expectations of the president elected and stuff. So it started pumping, and after the election it kept going. But now we have like, why has it come down, right? It's because of inflation fears and taking loans. It's getting more expensive. That's obviously some of the things that these high growth companies do a lot of, so that will cut into their margins, stuff like that. But the one thing you have to keep in mind, there are so many factors. Every time the inflation goes up, well, then they raise the rates, and then suddenly it gets cheaper, and then they can sell their product for more. And there are all these different ways. And if you aren't like a highly educated macroeconomics guy, then you just can't really have a clear picture of what is going on here. You can see like one indicator, inflation is going up. That is good for these companies that will eat away their loan. But then rates go up, that will cut into their margins. All these things, they kind of outweigh themselves. So the thing that you can always just look at is the stock price. If suddenly it goes down right here, if suddenly it goes down 40%, or in like a week it goes down 10% or 5%, then buy the goddamn thing, because there will probably be some reason, or there will always be a reason why it went down. But the thing is, most of the time the markets overreact, so you have to keep that in mind. On QCLN we have a historical dividends of around 1%. That is, that kind of varies because it's just all these companies and their dividends vary. So the expense ratio on this ETF is kind of high, 0.6%. That is on the high side compared to like S&P 500 indexes. But the thing is, with all these clean energy ETFs, most of them that I've looked at all have above 0.5% expense ratio. Just hard to find a clean energy ETF with a low expense ratio. That is just how it is. So this is on the high side, of course, but that is just. So maybe if you're good at picking out stocks yourself, maybe take a look at the portfolio and pick out some of the best stocks yourself. Now that they are not really that diversified, then that can maybe be as good of idea. I'll link some videos here if you want to check out icln, and if you want to check out a video that I did on 3 ETFs, like comparing them, and yeah, go watch them, and I'll see you in the next one. Have a great rest of your day. Bye.